Well, good evening, everybody, and welcome to the May 25th, 2021 version of the Investors Roundtable. My name is Ken Kavula, and I'll be one of your hosts this evening. I represent the Mid-Michigan Council of Better Investing. I'm joined this evening by my good friend Mark Robertson, and Mark is the chairman and CEO of Manifest Investing. Cy Lynch is also with us this evening from Atlanta, and Kim Butcher is joining us from Southern Florida, where it's sunny and beautiful, she reports. Let's get this show on the road. How about it, Mark? I'll turn it over to you.
Okay. The cover slide is a tribute to Memorial Day traffic. Which happens in a number of locations around the country. All right, get the legal paperwork out of the way here first. No investment recommendation is intended during this webcast. This is an educational demonstration. What that means is we're taking 80 years of lessons and trying to share them with you with respect to a group of ideas, stock ideas, and we do that to illustrate and demonstrate the methods and techniques of the modern investment club movement. Specifically the analysis techniques that have been put forth by the National Association of Investors / Better Investing, and the same type of stuff that we use at Manifest Investing. Anything that you see or hear from us is our opinion, and please do your own homework. We do try to remember to let you know if we happen to have a stake in something that we're talking about. We do these events monthly, and if you'd like a reminder to these monthly webcasts, we are beginning our 12th year here in a month or so. Send an email to nkavula1@comcast.net, and Natalie will add you to the reminder list. She will not inundate you with email. She will merely let you know when these events and perhaps a couple other educational opportunities come your way. If you'd like a copy of the slides, or if you have follow-up Q&A, send that to me at markr@manifestinvesting.com. All right, here's our agenda, our standing agenda for the evening. Welcome, everybody. We see a lot of familiar names, but we also see a few new names. We do try to keep this fairly informal. We monitor the questions tab, and we will open the mic up, especially for that open Q&A at the end of the session that you can see down at the bottom. We do keep track of how we do in the performance results. We'll talk about that in a minute. We'll take a look at the tracking portfolio for again, it's almost 12 years now that we've been doing this, and we'll take a look at that tracking portfolio as part of the program. Then you see the 4 stock presentations by the 3 knights and our damsel, Kim. We do invite the audience to vote on the 4 suggestions. Even if you're here for the first time, you're encouraged to vote, and we welcome that. All right, here's just a quick reminder of what we're doing. Like we said, we've been doing now for almost 12 years. We are sharing an idea, which is at the top of our radar screens. We do encourage some non-core selections, special situations, early stage companies, that sort of thing, and we try to limit that to about 25% of the total positions. Some non-core selections become core over their lifetime, etc., and we do spend some time talking about that. The goal is to basically have the collective performance achieve a long-time relative return that is beating the Wilshire 5000 by 5 percentage points or 500 basis points. And we do like to see a majority of our selections outperforming the total stock market index. Here's a quick look at the performance over the years. You can see that we have a rate of return since inception. That was July 2010. The annualized rate of return for all of the transactions that we've done, all of the decisions that we've made, is 18.8%. If you had put matching or mirroring investments into the Wilshire 5000 over that same time frame, the rate of return on that set of benchmark comparisons would be 12.9. The first minus the second gives you the relative return of plus 5.9. It is our hope and goal And it's the goal of many investment clubs, as denoted by that red line, to beat the stock market, the general stock market benchmark by 5 percentage points. And you can see that we are tracking slightly above that. And so we hope and pray that that continues, and that, over the long term, that really does stack up and contribute mightily to performance. Our outperformance accuracy is running at 53, 54%, and that's not bad. We'd like to see it a little bit higher, but it's still, the main number is that number at the very top of the page to achieve that type of number. Ken, any comments or questions?
No, I'm glad to see the trend back up again, Mark, for the last 3 or 4 months. It's a good sign. If we could keep it at that +6, +6.5 area for a long period of time, I'd be extremely happy.
Yeah, the market really was zooming along pretty well. So even as we were going up, the market was really tough to stay ahead of there for a while.
Yep.
Okay. Well,
and I would just comment, you said a little bit above 5% goal, which right at 1% over our 13 or so years. That's not bad to do, but over 40 or 50 years, 1% is huge.
Yeah, it's probably
even over goal, which is why, even if you don't make your 5% goal, you make 2, 3, 4% over the long haul, you're going to be doing very well.
Yep.
Yeah, I agree, Si, that if you had return on any of the dots on this particular graph from our third year onward, any of these dots are really pretty decent performance for any portfolio.
Okay, let's go ahead and press on and talk about the portfolio itself. A few months ago, we made the decision to separate the portfolio into two components. The majority of the portfolio consists of core investments, and we define them as shown in the box on the upper left there, or the colored Einstein. Basically up straight and parallel companies, very blue chip, very high quality, established, the type of company that is just automatically comes to the tip of your tongue when you talk about blue chip or core. On the right hand side, we have these a little bit more adventuresome type of companies. Companies that are examples of that might be Amazon several years ago. Companies with less track record, perhaps a turnaround situation. Just the opposite of up straight and parallel in some cases, but still companies that you can invest in and make a great deal of gains. So the portfolio is divided into those two pieces, and you can see from left to right the key characteristics of the portfolio. You can see that it's about an 80%, 20% split right now, and you can read the numbers from left to right yourself. The key numbers that are most important, and I'll go ahead and steal your thunder here, Ken. The overall return of the portfolio, the weighted average return forecast or projected annual return is about 11.2, and the average stock right now is running about 6%, 6.1. So we're trying to stay 5 percentage points ahead of that, and we are right there. Now, Si, you had mentioned something in one of our pieces of correspondence that you were concerned that was a little low. I wonder if you were just looking at the core portfolio.
Yes, I was looking just at the core portfolio. I was not combining the two of them.
Okay.
As you were talking now, I was just having that thought.
Okay. Well, that would account for it. We have restored this to a level that we want to maintain. The overall quality of the portfolio is fine at 85.1. Again, a very strong contribution from the core components that are in there. We'll take a look at those specifically in a second. And then this one over here just warms our heart. The average sales growth of a company in the portfolio, the weighted average of all of the companies, is 13.7. We really like to see that in the 12 to 13, and maybe even stretching a little bit for a demonstration like this. And that's got to make you smile a little bit, Ken.
It really does, Mark. I'm a little bit surprised that the core projected PE is actually a little bit higher than the non-core projected PE.
Yeah.
I would expect those numbers to be reversed, but it is what it is. I just am a little bit surprised by it. That's all.
I just noticed that too, Ken. My guess would be, I mean, you could look at individual companies and try and sort it out, but it may be one of the examples and why the core portfolio also is down to 9.8 projected return to an extent as well, is you're seeing a late bull uncertainty, even though, you know, we've actually had a bear market for a month or something. But you've got a maturing market flight to quality that I think has pushed up many, you know, core blue chip type companies to very high PEs. Because of course 28, that's what, double what you would normally expect this sort of portfolio probably to have.
Yeah, maybe not quite double, but a 20-ish number is fairly normal for the core component for sure.
Yeah, I was thinking in the 15 to 20 range.
Yeah.
To my double. So yeah, double's probably a bit of a stretch, but yeah, because that jumped out at me too, Ken. And similarly, probably the reverse is going on in some of that non-core. That's part of why that 16.9 is as high as it is. Those are out of favor. Even some of the early stage, you know, not just turnaround out of favor, just high, even some higher growers and so forth are probably somewhat out of favor right now relative to the market.
Well, I snuck ahead to make sure I was grabbing the right numbers for the sheet, and I was. So you can actually see the. Go ahead, Ken.
Maybe what we need to do, Mark, and if you want, if you can do it electronically, that'd be better than me doing it by hand. But maybe we still need to maintain a total portfolio on Manifest on that list of dashboards that we keep. Maintain a total roundtable portfolio so that people can see the combined portfolio. I know when I pushed roundtable for the first time a month or so ago and the dashboard came up, I didn't notice that it was just the core dashboard, and I became a little bit concerned until I noticed that there were stocks missing from the list that included our non-core holdings.
Yeah, we can certainly do that. I mean, it's obviously kept all in one piece in the tracking spreadsheet in the portfolio, so we could do that. The public links for the two pieces of the portfolio right now, and we probably will add a third as was just suggested, are right there. Here are some snapshots of the two. And again, for clarity, what we do is we invest $1,000 into any decision that is made, either by a knight, a damsel, or the audience. So if a company is selected, we invest $1,000 into it. That's what this legend up at the top is for. You can see Microsoft here has been selected 5 times, which means that $5,000 has been invested in Microsoft. That $5,000 is now worth $63,000. So that's how you basically decode that. What you're looking at here is the top 20 by percent of total, or percent of total assets. And there's another, 20 or 30 companies that are not shown on here. These are the totals for the entire portfolio, but these are the first 20 in the core component of the portfolio. We'll do some maintenance with that. But there's some pretty interesting ones there for sure. I see that Cy has gotten Axe up onto the list, so now he can maybe back off a little bit, but he seems to get stuck like a skipping record on the turntable.
Yes, sir.
It's a wonderful one to have moving up the list when you consider how well it's been doing recently, Mark.
Absolutely. I'm just poking good, clean fun. In one of Hugh's original selections, Costco, that's been with us for over 10 years. That's a one-time selection. That's why if you're looking up here in the audience looking for Costco, it's not there. It's only been selected one time, and that's when investing is fun. Check that out. It's on this list, and it's only been selected once. There's a couple on here that have only been selected twice, I'm sure also. All right, so let's keep pressing on. This is the entire non-core portfolio. And again, when you're looking at non-core, it's going to fit that definition that we gave just a couple pages ago. But you're typically going to see companies with lower financial strength, particularly lower earnings per share stability, and generally lower quality. those three elements kind of typify that sort of thing in these companies. And you can see from top to bottom, some of these are a little bit more of an adventure. Some of them are a little earlier stage. Some of them are a wild ride. And some of them are almost core. Any thoughts on the group?
It's really a fast growing class of stocks, Mark. 22+% growth. That's really quite impressive.
Well, here's part of your PE answer right here, guys.
Yeah. No, that's very right. And just looking at this portfolio, Mark, I think I would echo Ken's suggestion that combining the two portfolios might be a good thing. Because again, if you just look at, just like you look at the other portfolio, you say, gee, the return's a little low. You look at this portfolio and return's about the only thing that's any good. Yet you put the two together and the portfolio makes sense.
Yeah. Okay, well, let's keep pressing on. We really don't need to take any portfolio action, so we would be on the vanguard or be vigilant for perhaps single issues or single positions that might be trending towards. In the case of core, which is these first three, we'd really only rake these over the coals if their projected annual return approached zero, basically current money market rates. And that's really not even true, even with the lowest of the group there with Illumina. And again, we don't have to take any overall portfolio action, so I would submit that those are still okay to monitor. I think Charles Schwab, but it'll be interesting to see how the combination emerges and the integration takes place with Ameritrade. But I would submit those are all still okay, considering that the portfolio doesn't really need any boosting. Same is true for the non-core. I mean, there's nothing that's dramatically less than the average return on stocks, which is about 6%. So these are both pretty good. Plus, Tyson is very nearly a core holding now, based on the sum of those three numbers.
Mm-hmm.
So I don't see anything to get too excited about up at the top. Now, on the rule of five, there are a few companies that are misbehaving a little bit, but we've given them a little bit of a long leash. And A2 Milk, we asked the question last month, has the story changed? Really, the only change in the last month that I'm aware of is Oatly is out with a direct competitor to A2 Milk, basically, that could create a competitive situation. And the situation in China, where A2 Milk exports a lot of stuff to, is still gobbled up by the COVID-19 situation. Now, Sai, do you have any comments on Vmware? I mean, it still looks pretty good. It's lagged a little bit. You put the two positions together, and we really don't have a triggering situation there at all.
Yeah, I don't. I mean, it's it's just hitting a bit of a speed bump, but I don't see any real reason to chunk it.
Well, and it seems to be, VMware, Mark, seems to be super sensitive to anything that Dell says or might do.
Yeah.
Dell owns a large piece of VMware, and I think they've kind of dangled the idea we might sell, we might not sell, guess what we're going to do next into the market to maybe increase a little bit the idea that VMware is maybe going to be standing on its own at some point.
Yeah, I think that's, and because Dell owns so much, it's a relative, I mean, it's not thinly traded in the traditional sense, but as, for big companies, it is a relatively thinly traded stock. And then you get, as Ken says, Dell playing with it a little bit, I think.
Okay,
we had quite a debate.
Of course,
I'm going. Yep.
And I was going to say, and of course, notice now again, we keep talking relative to the market, and that matters tremendously. But if you notice, VMware still is positive on both those positions, pretty decently positive on one of them. It's just that the market has kind of gone crazy during the same time, and so relative to the market, it's down. Now, again, relative to the market is what matters, both positively and negatively. But it's not that there's something so fundamentally wrong with VMware that the market is completely trashing it. It's just not keeping up with the market.
Mm-hmm. So
it's quite a debate on CNBC, Mark, in the last, I don't know, 2 or 3 weeks between 3 of the brand new mothers on that television network, debating what milk really was, and coming to the conclusion with the Oatly CEO, they had him on the hot seat, kind of, asking him to define the word milk, because Oatly is trying to use the word milk with oats, oat milk. And they were quite insistent that while it might be something that was beneficial and might be something that was delicious and might be all the things he said it was, it certainly wasn't milk, and he should acknowledge that. It was quite they really had him pinned down and squirming a little bit.
Yeah, I mean, that's the lobbyists are pushing that pretty hard. And, oh well. So I mean, I'm just going to beg for a little more time with A2 Milk to see what happens, see if the story changes, see if China opens up at all, and we'll just let it ride. The other thing that we do watch for the audience is for a relative strength index greater than 80. That doesn't mean that we sell something, but we do basically a check to see if it's a selling opportunity or not. And we don't have any of those right now, but we have acted on those in the past. But these are basically the 3 elements which can result in the sale from the portfolio.
Mark, we have a hand in the air right now. Let's see if the gremlins are with us this evening and if we can unmute somebody, okay? Victoria, you're muted on your side. If you want to unmute yourself, we'd be glad to speak with you. Victoria, you'll have to unmute on your side in order to speak with us. And we're going to chalk that up to an inadvertent hand, Mark, and continue, okay?
Okay, and hopefully Kim's still around with us. We might have to shuffle the order if she had to go take care of business. Kim, are you still with us?
Guilty, I am here.
Okay, well, we are ready for the ROAD, Construction Partners dissertation.
Yeah, everybody talks about that there's going to be more infrastructure, it's going to be spent. Biden's trying to push through a bill. I went looking, I found this stock ROAD, R-O-A-D. It's that's the call letters on the stock, but it's Construction Partners. They are a vertically integrated infrastructure company that works across 5 states, and basically they have all of the that hot black tarry stuff that they make roads with. They have a mix of it. They've got 9 aggregate facilities, 1 liquid asphalt terminal, and their public funded projects make up a majority of its business in the state and local roadways, as well as highways, airport runways, and bridges. Most of their projects are maintenance related, but they do get private sector projects, which is paving and helping building sites get started for office and industrial parks, shopping centers, and all. I presented the stock in March and it was $30.06, and today it closed at $31.28. In after hours, it closed at $30 even. So we've had 2 months go by, it's about the same, but there have been a few things that have changed. One is that they reported out on March the 7th, and truthfully, they didn't have a good report out because they had a drop in revenue by 13.5%, and also a drop in earnings per share. So why am I still liking this company? Well, I have found in my library, I have the Value Line Special Situations newsletter, and that's where I found this stock. And I am kind of like Mark. I really like Value Line and their thinking heads back there of how they do analysis. And I thought, I like the idea. At the time that this article was written as of March 2020, 2021, that's a spelling, that's an error on my part for the date. The price was $28.71 and the 3 to 5 year price target is $62. That's a double. I'm pretty happy. Next slide. Okay, basically, we know our roads are crap. We know they need to get worked on, and they are in a 5 separate area, and there is a whole lot of individual infrastructure plays like this, but there's not very much consolidation in this, and this company is going after the consolidation of these to get them all underneath one roof. Now they're the leader in this area, and they have 48 distinct markets. They're the top 30 of domestic heavy contractors. They got a lot of momentum going on. This company's only been around, I think, like for 8 years. They've got a lot of tailwinds. We've seen where we've got a lot of spending that's going to be talked about for public and private spending. They have a history of expansion, and one of the things that I always like to look at, their way of expansion is acquisitions. And further on in the presentation, I'll tell you one of the areas I like to look at on Morningstar to tell me whether or not they are spending prudently when they're acquiring new companies. They like to, when they buy a company, they add all these employees, but then they standardize all the computer systems across the board, which improves their bidding, improves their job execution, and their financial controls. And in the last quarter, they bought 4 more companies. In the past 6 months, as a total, they've acquired 13 hot mix asphalt plants and added more than 300 employees. So they do have a lot of SG&A because of adding all these extra employees and all that they have. Next slide. They do have consistent top line growth with double-digit earnings before interest, taxes, and depreciation with their margins. Good balance sheet, lots of great management. They've got a lot of experience doing what they do with acquisitions. And their 3 levels of growth are: number 1, acquisition; number 2, greenfields; and then organic growth. Those greenfields or organic growth is looking around and finding out how they can expand what they're doing with the customers that they have. They've got a lot of vertical integration, lots of diversified products. They just seem to know what they're doing, and they're in the local areas of these 5 states that kind of know all their competitors going out there, and they're still finding a lot more companies to possibly to be able to buy, because people are wanting to maybe get out of this business because it was a family business. And we recognize, all of us, that we have poor and deteriorating roadways, because I can't tell you how many times I have to take my car in, because I think my car is just attracted to every pothole there is. So you've got to have a lot of maintenance, and they've got a great home-based workforce because they do everything local. Next slide. That can't be right. I must have hit a button on my computer. Okay. One of the things I learned the hard way is when you have a stock within your portfolio who does acquisitions, you really want to look and make sure that they're spending the proper amount of money when they're buying a company, because what it impacts is their goodwill. Now, I got this from the Morningstar website. Mark's got his little red pen there, which I love. You look at goodwill across, because you can put this in percentages. Notice that their goodwill as of March of this year was only 12.6%, essentially. Anytime, and I'm going to put a big red star here, Mark, anytime I have a company and the goodwill is over 30%, I have been burnt. Stock prices drop like a bomb because they have had to write off some of that goodwill because they spent too much money on acquiring another company. So this company, Road, has got great management and capital allocation to grow the business, but not spend too much money on those companies that they buy. Next slide. As you can see, they've got a proven success rate in their strategy of execution with having all these acquisitions in greenfields. They're in 5 states. And look how much they've grown overall. And that's just a line that keeps going up. And 2021 revenue guidance is to have $950 million to $1 billion in revenue. That's the guidance for this year. That's quite a bit, guys. And they just seem to doing everything the right way. Next slide. Now, we're crossing our fingers. Biden put forth this infrastructure bill, and ultimately, they've already reduced the amount it's going to be. But what are the grades of the roads that need to get worked on? Okay, North Carolina's a C. South Carolina's not rated. Georgia's a C+. Alabama's a D+. Florida's a C. I'd probably say it's a D. But they've also raised the gas tax. So when you realize that publicly funded projects account for 60 to 70% of the revenues, and they like to diversify, so that means that this company they kind of know where they need to go and what they need to do to be able to get the business. They've had a historical success rate of doing it. Next slide. Now all these slides I'm using now are from the last quarterly report, which was on May 7th. The big thing I want you guys to look at is look at how much that annual revenue keeps going in the first box. 59.3%. They keep on moving up. Ultimately, the backlog is the big thing here. Put a big circle around that 773 million mark, please. That's what their backlog is. They had lousy revenue and lousy earnings in the last quarter because it was the not really great weather, rain. You know, some of those cities in the Carolinas had all kinds of rain and bad weather. They couldn't get things done. So they've got a great backlog. And the other thing is 40% of their revenue comes from the first half of the year, and 60% of it comes from the end of the year. So that's an awful lot that they keep going forward. Now, also the one thing to consider is that on April the 26th, that this would not be reflected in any of the numbers yet, which is going to impact this company, that Apple announced that they're going to build a $1 billion campus. And they're going to give $110 million in infrastructure for bridges and maintenance work for doing what needs to get done. And I think that's also because this company has, in the Research Triangle Park, they've also been able to do a lot of that work. Let's see here. I got this, a friend of mine sent me this from a newsletter saying Apple will contribute more than $100 million toward the roads and other infrastructure spending across the entire state. Smith, who is the CEO, told analysts that Construction Partner has done most of the paving work in the Research Triangle for the past decade. So this gives a huge amount of opportunity for the North Carolina market for this company. They felt that due to an upgrade in the revenue outlook and the intrinsic value, they felt that buy up to $32 and gives you a margin of safety of 25%. And if we're at $30 now, and 5 years from now, it's supposed to be 62, there's your double like we like of our 15%. Next slide, Mark. There you go.
Yeah, I just threw in the summary slide kind of as an appendix that people could see some of the figures. obviously that growth picture in the upper right is pretty strong.
Well, when you've got that going on and you've got, and one of the things that Mark always likes to talk about, and I do look at it also, the RSI in this company was 52.51 as of today. And I also like looking at Bollinger Bands, and I like buying a stock when it is below the midpoint, and that's what this stock is. So I will tell you, if I have the internet, because I didn't get the internet till 5 o'clock tonight, I'll be planning on buying some road stock. Thank you, guys.
All right. Thank you, Kim. All right. I'm up next in the lineup. Thought I would go through and share some of the stuff that we had talked about this afternoon. Just a quick screen. What you're looking at in the upper left is basically the companies in the Value Line Standard Edition, the investment survey, and how they break out into buy, hold, and sell zoning. And want to focus in, obviously, on those 71 on the left. This is just basically confirming it's a little harder to go shopping and finding a stock to study right now. I wanted to wean that down, so I went with quality rankings greater than 60 to stick to just excellent and good companies. That drops it down to 43. And then I wanted companies with double-digit projected return on value, so prove greater than 10%, and that actually got me down to my baker's dozen that are on display here. The projected return on value is just what is in the definition up there. That is the math. It's just a little bit different way of looking at things, focusing in on a little more carefully on total liabilities and cash, and basically using the same stock selection guide that George Nicholson used 80 years ago that focused on sections 1 and 2A. That's what that's all about. And so here are the 13 companies ranked from highest projected return on value. A real interesting list, including our recent selections of Regeneron, Alibaba, for those who are willing to invest in China. I skipped the next 3, but with special mention of Emergent Biosolutions, EBS. That came up during the conference last week, and that actually has some compelling attributes. But some of the educational services companies check in there. Pets, iRobot, which was presented at the conference. Ken pointed out this afternoon, it was kind of fascinating to see Merck in there. That might be worth running up the flagpole if you're looking for a blue chip company that could qualify. And I just went through and picked out some of the better looking numbers, and I end up with an old friend that used to go by the name of Strayer Education, and we had our moments with Strayer, good and bad, about 10 years ago. And I think I might be ready to tiptoe back into the water based on those numbers from left to right, including the fact that it's at a very low RSI, which means it could be oversold, and that's also borne out by the upside-downside ratio being double digits. It just means it's close to the 52-week low right now. And back about 10 years ago, Ken and I had a long discussion about the challenges coming at the educational services companies, basically the for-profit educational institutions. And he asked me to envision that I was standing on the rails down there on the lower left with that coming at me. And he says, well, Mark, you have a very simple decision. You can either take a step to the left or a step to the right, or you could stay where you're at and it's not going to be pretty. So back then, when the federal government was really coming down on these companies, and there were a number of companies misbehaving, and I'm sugarcoating, many of those companies actually went bankrupt and failed. Strayer and Capello were 2 of the more respected companies in the field, and they survived, and they went on to merge in 2017, 2018. Strayer focuses more on the undergraduate side of things and trade skills. Capella has more postgraduate type stuff. So it's a pretty good blend, and they are respected, and they both have fairly well established online and hybrid type learning opportunities. Strayer has a few more in-person campuses and that sort of thing. But up at the top, you're looking at the strategic education is now the name of the company, as it says down there in the lower right. and you basically set the time period from 2010 to 2018 aside, because that's pre-merger, and focus in on the right-hand side of the graph. And what we see is the combination of the two companies is projected to grow at 5 to 6%. Here's a look at the profitability of the new combined company. Again, paying a little less attention to the chaos and bedlam on the left, because there was a whole lot going on, and that's pre-pandemic. There was a lot of stuff going on and shenanigans and that sort of stuff in the industry. Again, these two companies were less guilty of some of the challenges faced by these companies, but coming out of it, looks like a pretty good profitability picture going forward, and that includes impact of the pandemic. They've actually done fairly well, and they've provided support for other universities, free online training packages for universities that didn't have quite the, I'll use the word infrastructure, the online learning infrastructure in place, and they've actually gone out and helped a bunch of other educational institutions, and they've actually turned that into kind of a subscription service for the coming year, because it went over pretty well. Here's a look at the PE ratios over the years. Again, one of the reasons I point this out is this is a way to notice a turning point or an inflection point as you're looking over data for any company. You've got to wonder about those bars in the middle as being perhaps an unusual event. And again, we want to focus on the right-hand side. By the same measure, I mean, you can see the shares outstanding. Actually, we had a step change between 2017 and 2018. So as you're looking over any data array, looking for a material event, that's an example of one right there. That's where the merger happened, and the two companies became the current company. Here's a look at the stock price charts over the last 10 years in the case of the upper left, and you can see there has been turbulence and turmoil, and they've had kind of a rough go of it on the stock price side for the last several months. The last 6 months are shown on the upper right, and they are facing a number of concerns and perhaps a little bit overdoing it as far as the perceptions and some of the damage that has been done. The chronicle for the last 4 years is shown on the lower bottom, and you can see that we do find a company with generally increasing quality after the trials and tribulations that they went through. And we also find something that we always like to find, a stock trading at a return forecast near its multi-year highs. Again, the stock price has been under pressure. That's what you're seeing down here. But the fundamentals of the company have remained pretty much intact over that time frame. So some fairly good stuff. So here's what we're looking at. A $1 billion company now projected to grow at 5 to 6%, trading at a price of 73, down from 92 just a few months ago. So they've actually lost a little ground here in the last 6 months. A projected net margin of about 17 or 18%, which is pretty consistent with what we had seen, seems to be feasible and achievable. And a PE ratio in that 20 range. Those three major milestones basically generate a projected return in the 22 range, which is pretty attractive these days with the average stock at about 6%. The only thing that I don't care for too much for the portfolio, although we've got some room because of that number we talked about earlier, the overall sales growth of the portfolio at 13.7, we can afford a few of these, especially if it's a special opportunity. I don't consider this to be core because of the challenges that the company faces. I would consider it to be non-core. And for everybody's information, here's the whole picture from top to bottom with all of the other aspects. You can see that they have done a little bit of recharacterization, taking on a little bit of debt at an interestingly low interest rate. Here is your RSI in the low 30s. Really nice numbers for the long-term forecast here. Confirmation on the projected return on value being in the low teens. Again, that's compared versus an average company in the 5 to 6 range. Buy according to the zoning, high quality, and again, that 22% number based on those assumptions that we made. Obviously not an up straight and parallel history, but some pretty good opportunities going forward. Again, focus on the right-hand side of that. And it is possible for this company to chug along and do pretty well for us. I'm going to throw it on the pile, watch it closely, put it in the non-core side of the ledger, and hope for the best. So with that, we will go
Mark,
to...
I have a hand in the air. I don't know if it's about Strayer or not, but let me unmute the person since we have a moment right here, okay?
Okay.
Bo, this is Karen Beauregard. Bo is a director for the Mid-Michigan chapter. And Bo, did you have a question for Mark?
No, I'm so sorry. My hand ought not have been in the air.
Okay, I'm going to put it down then. Thank you.
Thank you.
Well, great.
It was applause, I think.
It was applause? Well, thank you.
Mark,
Great
while
presentation there, Mark.
while we're on a break, Mark, do you remember the Better Homes and Gardens indicator?
The Better Homes and Gardens indicator. I should refresh me.
Well, remember at the time we were discussing all these companies, there was a long article in Better Homes and Gardens about Strayer Education and about how it was a great stock to take a look at. And as it cratered about 6 months later, we decided that any stock that we read about in Better Homes and Gardens was probably a stock we wanted to stay away from. So I just wanted to know if any of your research came from Better Homes and Gardens this time.
It did not. And I actually remember
It did
now
not. Okay.
that you mentioned it. I can remember years ago when, well, you know, Enron was featured on a number of magazines before their demise. And many years ago, Micron Technology, before it had a real major stumble, was featured as on a number of major magazines. But yeah, Better Homes and Gardens. I have to check. I don't believe they've been on those pages
They've
recently.
weighed in on the situation yet. Okay. While we're breaking, I have Robert with his hand in the air. So Robert, you are unmuted, but you're muted on. Go ahead, Robert, if you have a question.
Yeah, where does that summary sheet come from? The slide that was up before this, number 27?
Oh, that's just that's an Excel spreadsheet that we use at Manifest. If you want a copy of it, just send me an email.
Okay, will do.
Okay, Mark, let's move on then to size pick.
All righty. And tonight's pick, and last February's pick, and last December's pick, and last October's pick, all that's for Mark since he's harassing me for being stuck, is Axos Bank. And you can see relatively up straight and parallel, very consistent sales growth over the last 10 years and pretty consistent profitability and earnings per share. Next slide. I was looking pretty hard at accumulating a stock rather than looking for a new holding this month. So I started with the portfolio, ranked, and lo and behold, on the core holdings, Axos Financial came up at the top, as you can see, with a 30% growth rate in book value, which is what financial stocks are looked at in Value Line. I mean, not in Value Line, in Manifest, and very high quality and a high par in the yellow zone. In fact, normally I might say that's a bit too high, but again, for very high quality, it didn't alarm me. And as you see, my judgments will be a little bit more modest and won't be quite as high, but still very good, solid return. Next slide. I always like to take advantage of a quick industry study, comparison guide using the Manifest tools. Here, ranked by par. Not surprisingly, it's the highest potential return in the industry. Western Alliance certainly looks attractive with decent quality, but not quite as a stable earnings. And Axos has higher growth, plus, again, 3.5 percentage points in return is nothing to sneeze at. So I liked Axos again. Next slide. Ranked by quality, it's right up there. None of these companies on this excerpt from the regional banks industry guide, all of these are roughly the same. There's not a whole lot of difference between the 98 and certainly Axos 96 or even HDFC's 93. And again, one of the highest margins of these companies you see, the highest growth rate, and again, the highest return. Next slide. So a little bit about Axos for those who need refreshing, or if you haven't seen a previous presentation, there's a link at the bottom that you can go and see all of the slides the company puts out. And they do periodic, just general investor presentations, usually every couple of months, that they update some of their slides, as well as their quarterly presentations and various analyst presentations. They were born digital. They stay focused on digital, and really what they've kind of started describing their company as and pitching their business model as, you see down at the lower right-hand corner of that photo. Banking evolved because they started digital, very consumer focused, and they've evolved into a full service bank. Next slide. They've never been a brick and mortar entity. They've always been digital. They do have some physical locations, but that's not what their business is all about. They report three segments: consumer, commercial, banking, and securities. They are up now to nearly $15 billion in assets, and you can see the range of products that they have, which is just about every type of banking product that any bank would have, and they are entering big time into the investor arena, servicing investment advisors. I'll talk briefly about that later on. Next slide. Just a couple of key things for banks that I like to look at, and I called it profitability excellence. Banks make money one of two ways: selling money or renting money, really, which is loans, borrowing money through deposits, and then loaning it back out to the public through loans. And the difference between the interest rates is called net interest margin. And you can see here over time, they give you the Fed funds rate that was rising for the first 4 years, fell significantly in 20, and it's been fairly flat, maybe slightly up in the last year. And you see they've kept their net interest margin very stable in both raising and lowering interest rates environments, and that is a good high net interest margin. Next slide. This is the gets into a few other profitability measures. The efficiency ratio down at the bottom I'll mention first, because that's the second way that banks make money, which is through non-interest income, largely fees, and you take the fee income and compare it to fee expenses, and that is your, or not fee expenses necessarily, non-interest income and non-interest expenses, largely fees, and that is the efficiency ratio. That's the cost to produce a dollar of non-interest income. You see that their profitability is well below 50%, or the cost is well below 50%, profitability well above 50%. They're in the top 8% of their peer group. Their return on assets, return on equity also very strong, and those are important bank measurements. Next slide. Wrapping it all up, why invest in Axos tonight? Strong historical business performance. Sales have increased over the last 10 years in excess of 25%. They were growing pretty close to that for the last couple of years, with a hiccup in the last quarter down to about 12%, but that was because primarily the loss of a contract with H&R Block for tax refund related products. So that loss of that business caused their growth to fall to almost just below 13%, I think 12.9% in the last quarter, but it actually boosted the quality of their loan portfolio, which you see here. No loans are in forbearance and their non-performing assets are decreasing. Good sign. Rising business fundamentals manifest since I've been tracking Axos, a little under 18% in October, 19% in December, 24%, almost 25% growth in February, 30% projection today. And then I mentioned that I would talk about registered investment advisory services. They have a pending, they just announced about 3 weeks ago an intent to acquire E-Trade Advisor Services. That's providing brokerage services and back office support to registered investment advisors. Big business for companies like Charles Schwab, E-Trade. E-Trade is selling this to Axos Bank, and it will increase, the management says, will increase their non-interest income by 33% when completed, and they anticipate it to bring $25 billion in managed assets. Next slide. Here are my judgments. I used a more modest 17% growth rate, which is based on the last 18 or so quarters as a whole, though it has accelerated in more recent quarters. Then the pre-tax profit based on about the last 10 quarters, carrying the tax rate forward, gives me projected 777. Sounds like that could be an airplane, perhaps, but it's earnings per share projection, and that's a bit below the manifest consensus. So there's certainly some potential upside. PEs, I used a high PE of 18, average of 11.5, which is in line with manifest average of 13. Next slide. And I get a compound annual return of right at 15%, 14.9 using the average PE, and that's about 10 percentage points under manifest. So if manifest's growth rate of 30%, and by the way, I'm calculating revenues a little bit differently, so it's not as extreme as 17 versus 30. It's actually, I'm about 20% lower in my projections, as you could see in the earnings per share. But in any event, there's certainly, it's a solid return with my judgments. And if I'm a bit cautious or overly conservative, there's a lot of upside.
Okay, thanks, Si. And we'll turn to Ken for our final stock of the evening in Facebook.
Well, Mark suggested when I told him that I was going to do Facebook this evening that this would be a boomer's perspective on Facebook. So here goes the boomer. I will state right at the beginning that I'm not, I don't take a presence on social media. I don't have a Facebook account. I don't have an Instagram account. I don't have a LinkedIn account. I don't have any social media's accounts, and I'm perfectly happy that way. And I will live out the rest of my years perfectly happy without these accounts. That being said, Facebook is a force to be reckoned with. And I do own Facebook stock. I have owned Facebook stock for a long time. I'm in clubs that own Facebook stock. And I think it's an interesting time right now to be looking at Facebook stock. Mark has added to my opening slide the note at the bottom that says Facebook was a one-time selection in 2018 November at $135. Relative return of almost 22% since that point. He just wants to be on record that he found it first. So here we go. Okay.
Not only
Next
that,
slide.
But we always are sitting around lamenting that we don't go back and double down on one-hit wonders sometimes. And that's just a reminder that sometimes there's some pretty good ideas that have been picked one time for the portfolio.
I just captured the thumbnail that comes on the SSG Plus for Facebook. It does a really nice job of explaining exactly what the company does. And I want to zero in on the statement that says advertising revenue represents more than 90% of the firm's total revenue, with half of that revenue coming from the US, 25% from Europe, and the rest of it from other places around the world. And it has gross margins above 80% and operating margins at 30% plus. So this is a company that's basically dealing with advertising directly to you and your children. Your children might not be working on Facebook, but I think if you mentioned Instagram to your teenagers, they might be familiar with that particular product. And in fact, there's a large debate going on right now whether Facebook should continue developing the Instagram for Kids product. They are developing a product for people under the age of 12, and they're meeting some resistance from parent groups throughout the country right now. We'll leave it set at that. I don't happen to think that whatever might happen politically to Facebook will do a whole lot of damage to the Facebook investor. I kind of think that if Facebook should be forced to break itself into components, that the company might very well be worth more than the sum of its parts. And I happen to believe that Congress doesn't really understand the technology that they're talking about well enough to regulate it at the moment. Witness the hearings that have gone on. It seems like they're going on every 3 or 4 months, where they call Mr. Zuckerberg to Washington and then grill him about various things, ask him all kinds of questions, and then he goes home and they continue. I'm not sure what they're talking about, but they continue talking about it. So I'm not nearly as sanguine about the idea that Facebook is suddenly going to be penalized for behavior that it's engaged in for a relatively long time. And I guess that goes for the likes of Google and Microsoft and a couple of other large companies as well. Probably throw Apple into the mix as well. Next slide. Pretty good lines, up straight, parallel, reasonably parallel. A little bit of choppiness occasionally, but you can't see the pandemic in the earnings per share line. The advertising revenues continued very strongly during that time. They had a bang up last quarter. You can see sales up almost 50% and earnings per share up over 90%. So a real bang up last quarter. What's not to like about numbers like that? Next slide. Manifest seems to think that the par value should be around 15% with a quality of 93. They place Facebook third in the internet content and information industry, behind the two classes of Google stock, and they place Facebook third in the communications sector, again, right behind the two classes of Google stock. So all in all, I think that Facebook is something that is a major player in our lives on a regular basis, and we should take a look at it when it says the par is going to be 15% for this extremely large company. Next slide. I've decided to do an SSG based on historical sales growth of 20 and historical earnings per share growth of 20. There's been a little bit of dancing around in 2020 with pre-tax profit and return on equity, but both those numbers are superb. They're doing this with very, very low debt levels, as you can see. Keep in mind that the trend values, the up and down, the red and the green, are done by a computer. So you have to ask yourself if a 7.7% debt to capital load is really worth a trend in the wrong direction for debt, especially when it's down about 2 points from the year before. The same thing is true about profit levels. Profit levels in 2020 were actually up over the pandemic, and I would assume that I would see them back into the 40% again as we move into 4 quarters that aren't impacted at all by any of the pandemic itself. I'm looking at the historical earnings per share, and I decided to use an average high PE of 30 and an average low PE of 18. In other words, I cut the averages down at both columns. I continue to see the PEs for this large company maturing and moving into very reasonable places for this kind of growth. Next slide. All in all, I do the SSG, I get it in the buy zone, a par value of about 16.6. That's coming within 1.5 points of the manifest number, and that's validating my own analysis. I'm very pleased to present something growing as quickly as this stock with a par value at this particular level. Next slide. We're going to go to our poll right now. And if you give me just a chance to bring that poll up, I will do that, and then I will launch it. So here we go, folks. And all we're asking you to do right now is to add one of these stocks to the portfolio. That means that we would add a second $1,000 for the stock that you pick. And it doesn't cost anything for you to respond. All you have to do is take your mouse or your finger, if you have a touch screen or whatever you're using, and place a vote. I'm sorry for the misspelling there of strategic education. Looks like I have misspellings in a couple of places. I did these in quite a hurry right before we started on the webinar here.
Well, I think we're probably going to have to do some recounting or something.
You're gonna audit this, Mark? Okay, we better. I don't think we should go there. Okay. We have about 80% of you voting. I'm going to count to 10 or so in my mind, and then I'm going to shut the poll down. We're up to 84% voting. Let's see if we can push that to 90%. 5 more seconds. And I'm going to close the poll, and I'm going to share the results. And we're going to add an extra position in size Axos Financial, as well as the position that he added himself this evening. It certainly is an interesting regional bank to take a look at. If you were back investing before 2008, before the Great Recession, you might have known of Axos Financial as IndyMac Bank. And I actually belonged to clubs that owned it way back then. And to be honest, that club has never turned around and taken a second look at this bank in the last 10 years. Maybe it's time for us to do the same.
Yeah, and they were also Bank of the Internet, BOFI, for a while too.
Yep. I'm going to hide the results. And Mark, we want to move on.
Okay. Let me see if I can get.
I'm still seeing just a placeholder. There we go. Our next calendar, and our roundtable will come up in June, and then again in July, the last Tuesday of the month. We will send you a message reminding you that it's coming up if you're on our notification list. And then, of course, it appears that we're going to go to Dallas this year. In October. It looks, at the moment at least, like there's fairly smooth sailing ahead with COVID and with everything related to COVID. I have my vaccination. I know that the members of the panel have theirs, and we're just kind of waiting to maybe start seeing each other face to face again. I got a call from our local library today, Mark, And the library board met last night, and they're going to be opening up their meeting room at full capacity starting on the first day of June. And that means that our Mid-Michigan Model Club will be able to meet face-to-face for the first time in, I think it'll be 16 meetings, but it might be 17 meetings. For the first time in a long time, we'll be actually able to shake hands with each other and smile and have a good face-to-face conversation.
Mm-hmm. Can't wait.
We do have some questions that we can get answered after we close down, Mark, but this would be a great time to say thank you to you and to Kim and to Cy. Thanks for all you do to help put this program on. And let's wrap this up, and then we'll stay around and answer a few questions at the end.